Good morning. My name is Brandon Hall, and I'm a research associate here at JP Morgan Asset Management. On January 20th, Donald Trump was sworn in as the 47th President of the United States, and since then, he has announced a series of executive actions and new initiatives. Today's webcast will focus on the day one actions of the new administration, diving deeper into their implications for the global economy and global markets. In the midst of all this, the fourth quarter earnings season is also underway, so we will discuss some of the key themes and takeaways we are hearing from recent reporters. For this conversation, I'm very excited to be joined by Chief Global Strategist, Dr. David Kelly, and Chief Strategist for the Americas, Gabriela Santos. And with that, David, it's been a busy couple of days. Let's kick it over to you to get things started.
It certainly has, Brandon, and thank you very much for joining us on this, and thank you also, Gabriela, for joining us on this, and thank you all to people tuning into this. Obviously, it's a busy time, but I think it's a very important time to take stock of where the economy investment environment are and how the policies of the new administration may impact that. I want to make my usual disclaimer right at the start. We are in the business of trying to help people make better investment decisions, period. So there are very strong views on the new president on both sides. I'm going to try and avoid anything referring to cultural issues or other issues which people feel very strongly about. But really the question is, well, what have we learned in the last 48 hours, but also in the last few weeks, perhaps, about the actions of the administration and how could that impact the investment environment? So specifically what I want to do is talk about, let me just very briefly review where I think the economy is and then talk about four areas of immediate action here in terms of tariffs, immigration, deregulation, and the budget, and then talk about what that might mean for the Federal Reserve. And then I'll go and turn over to my colleague Gabriela Santos to talk about the earnings season, because we're just getting going on that. But also, given all of this, what does the investment landscape look like at this point, and what should investors be doing? And then, as Brandon said, we'd love to open up for any questions. So first of all, before you think about what policy changes might occur this year, I think the economy is in a relatively good track going into 2025. My forecast for a year ago was 2024, 2% real growth, zero recessions, inflation coming down to 2%, the unemployment rate staying at about 4%. And honestly, a good baseline forecast for 2025 would also be 2024, growth running at about 2%, no recessions, inflation bumping around 2%, but probably ending the year close to that number, and then the unemployment rate also close to 4%. If you look at these pieces in turn, it looks like real GDP growth for the fourth quarter will be in the order of, I'm getting in the low twos. I know that Atlanta Fed is saying 3.0%. I think that's a little high. But the difference between my numbers and their numbers is I'm assuming a drawdown in inventories, which is a very hard thing to calibrate, to be honest, or slow growth in inventories. So if I'm right, it just means that we'll need to rebuild inventories a little bit in the first half of 2025. So either way, we go into the year with plenty of momentum. Consumers are flush with a lot of gains in their in wealth over the last year. We've had 20 straight months of wages rising more than CPI inflation. So overall growth looks good. Also, employment tends to lag growth in terms of employment growth. So the GDP growth we've seen over the past year of about 2.5%, that should be good to generate strong payroll job gains for the first 6 months of this year anyway, regardless what else happens. And if growth continues, I think we'll get 150 to 175,000 jobs created per month. I think you'll see the unemployment rate stay close to 4%. There is a big backlog, again, regardless of immigration actions taken today, there's a big backlog of people who've recently received authorization to work in the United States pending any hearing on their immigration cases, or people who've just come in through the normal channels and have automatically got authorization to work. And I think between those two, we should be able to find the workers to generate 150 to 175,000 jobs per month through this year, reflecting solid GDP growth. On inflation, the inflation rate did tick up to 2.9% year over year in the CPI numbers for December. But what we're particularly focused on is what's going on with shelter costs and auto insurance. That continues to come down. We think the comps for the next 4 months are very easy. So by April, the inflation rate should be down in the low twos in CPI and actually close to two on the consumption deflator. It could bounce around a little bit for the rest of the year, but overall, I think we'll be hovering close to 2%. So I think all of that is a fairly good backdrop, and there's nothing really to say we're going to have a recession anytime soon. It's not that the economy is going to have a soft landing or not have a soft landing. It had a soft landing. It's kind of like I don't know if you ever landed in Chicago O'Hare, but even after you've landed, it can be like half an hour before you get to the gate because the runways are so far away from the gates. It's kind of like that. We're just taxiing after landing. The economy is moving forward at a steady pace. Which brings us to new administration policy. So there has been an absolute blizzard of executive actions and also comments from the new president since he's taken office. Some of these have to do with cultural issues, which I'll leave on the side. But some of them are quite relevant for the economy, in particular what he has said and done on immigration and on tariffs. And then also want to talk a little bit about deregulation and the budget. So on immigration, he's made some strong statements about the southern border and about an emergency on the southern border and trying to send, or giving him the authority to send troops down there. He certainly allowed for the use of other government money to rebuild or to get going again on building a border wall. He wants to end birthright, which is the provision by which if somebody is born on U.S. soil, they become a U.S. citizen. He will have a constitutional problem with that. Eventually, it may need a constitutional amendment, and we know how difficult it is to get a constitutional amendment if you want to change that. And there are a lot of other actions. I think that there won't be massive deportations because, frankly, he doesn't have the manpower for massive deportations. It's not like there are a lot of immigration naturalization officials sitting around doing nothing here. They're quite busy as it is, and we don't have the manpower for massive deportations. But I think you will see deportations of people who've got criminal records. You will see some examples of deportations. And I think one of the effects of this is, regardless of how many people get deported, I think it'll have sort of a chilling effect on undocumented or unauthorized immigration, I guess is the best way to put it, coming into the United States. He's also wants to restore the Remain in Mexico policy. I think he's getting some cooperation from the Mexican government on that. So I do think that you will see a slowdown in immigration across the southern border. However, we have also seen in recent months an increase in immigration through more conventional areas, people applying for visas at foreign embassies. There may be a chilling effect on that as well. We just don't know about that one, but that's really important. Because if we simply effectively shut the southern border and reduce that immigration, it had already been coming down a bit, but if we reduce it completely, so long as you see an increase in people who are coming in through conventional routes, then the US will continue to have a plentiful supply of immigrants for employment. And I would say that this is pretty important. I mean, the first data we have on employment by nativity, or in a consistent series, is back in 2007. And since 2007, essentially half the employment growth in the United States has come from people who were not born in the United States. Most of the employment growth in the last 4 years has come from people who were not born in the United States. If we shut off immigration altogether, the economy will grind to a halt. So I don't expect that to happen, even under a more aggressive policy in immigration. But I think the president's actions so far don't suggest that we will be having we will be more aggressive in certain actions here. I still don't think that we'll have massive deportations or a massive immediate effect on the supply of workers. Turning to tariffs, we didn't see big tariffs put in place on day one. In many ways, that shouldn't be a surprise. I mean, I know rhetorically he said that he would put tariffs in place on day one. The problem is that there's a lot of negotiation to go on here from two perspectives. One, if you're using tariffs as a negotiating tool, we want to give the other side a chance to negotiate. You want to figure out what you're going to put tariffs on that actually harm them more than they harm us. So what the president has said is that he intends to put 10% tariff on China as of February 1st also. I think that we will I think we can see that can occur, perhaps, but there will also be some negotiations. And the really interesting point is the tariffs here are, people look at them through two lenses. One, they could be a negotiating tactic to open up foreign markets or to achieve domestic objectives like stopping the flow of drugs into the country or stopping the flow of immigrants to the country. That could be one of the objectives. But if then the other side complies, your tariffs go away. Or they could be, as the president has alluded to many times, a funding mechanism for his tax cuts. And I'll come back to the tax cuts in a minute. But if you decide that a sizable chunk of a very large tax cut bill is going to be funded through tariffs, you can't really use them as a sort of bargaining tool at the same time. You either have to put them in place or not. I think one of the interesting things about tariffs this time around is if they are a specific part of the pay-fors for a tax bill that is going to go through the House and the Senate later on this year, you're going to have to at some stage nail it down and say, okay, the tariff is 10% on all goods imported in the United States, or the tariff is 10% on all goods in the United States plus 50% on China, or whatever it is, but you're going to have to nail it down. And so I do think we'll get clarity as the year goes on if it is locked into this tax bill. And you know, while as an economist, I don't like tariffs. They do invite retaliation. They do push up inflation. I also don't like uncertainty. And so I think we will get more certainty on this as the year goes on. But for the moment, it is really confusion. And I think it will continue to be confusion until such time as we have to nail it down as a funding source for a tax bill, if that's indeed what the president decides to do. On deregulation, the president has signed a number of executive orders on deregulation, specifically on oil and gas. He wants more being able to drill in Anwar, reopen various waters off Alaska, try to rescind some of President Biden's orders on restricting federal land or federal or U.S. waters from drilling. He's also declared an energy emergency. I think the idea is that AI is going to need a lot of energy, so we're going to have to we need to have more electricity, and you've heard him say drill baby drill. So that is certainly going on. Outside of energy, though, a lot of the deregulation is more in the form of personnel than anything else. I mean, we saw 2 weeks ago very interesting signal as Michael Barr, the vice chairman in charge of supervision at the Federal Reserve, stepped down. He remains a Fed governor, but he stepped down from that position rather than get into a fight with the incoming Trump administration. If he's replaced by Michelle Bowman, as many people think is likely, you may have more of a pragmatist in terms of the regulation of the banking industry, in charge of regulation, somebody who's a little less tough, and that is essentially a sort of deregulation symbol. You've also got Lina Khan, who is a very aggressive antitrust head of the Federal Trade Commission, being replaced probably by somebody who's, again, a little bit more pragmatic. I think it's one of those interesting areas where on the campaign stump, the idea is to beat up on big business and on companies taking advantage of monopoly power. But when you think about who's funding elections, maybe less so. And I think you will find an FTC which is a little less aggressive or a little bit more choosy in terms of who they're going to go after in terms of antitrust. And then, of course, you saw Gary Gensler has or will be moving out of the SEC, temporarily replaced by somebody who's already an SEC commissioner, who is much more pro-crypto. And then ultimately, the commission will be expanded back to 5 commissioners with a Republican majority and a pro-crypto commissioner at the head. So it looks like the crypto industry will be a significant winner from changes in regulatory in the SEC. There may be other forms of deregulation. I'm sure there will be. There is a lot, I think if you look at, we've pulled out of the Paris Climate Accord again. We've removed mandates. The executive actions have removed mandates with regard to electric vehicles. I believe he's also removed mandates on vehicle emissions standards, CAFE standards. I need to double check where exactly we stand on that. But there's going to be some deregulation on environmental stuff. We've got some deregulation in terms of DEI and ESG initiatives. So I think there'll be a fair amount of deregulation, which will help business. But I do want to say one note of caution here is that a lot of the things that eventually end up blowing us up in the economy and in financial markets are because of a lack of regulation. You know, I mean, the financial crisis of 2008 couldn't have occurred without a good deal of deregulation. We do actually have a global climate problem. The world is getting warmer, and while there are good ways and bad ways of dealing with that, not dealing with it at all could have consequences also. There are issues with regard to the regulation of cryptocurrencies or regulation of mergers and acquisitions, which could cause problems too. So I think investors need to recognize that while deregulation may add to the average of real GDP growth, it could also add to the variance or volatility of GDP growth if one of these things blows up. And then finally, on the budget, I wrote a piece of my notes in the week ahead, and I recorded my notes in the week ahead podcast this week just on the budget, because the Congressional Budget Office put out their numbers last Friday, new numbers going out to 2035 on a baseline budget deficit. I'm really glad they did that on last Friday because they're able to do it then before all these executive actions occur and before they have to really take account of all of this. But what it shows is the deficit deteriorating the debt deteriorating very sharply. We're running deficits close to 6% of GDP, even if we don't extend the Tax Cut and Jobs Act of 2017. I expect that the Tax Cut and Jobs Act of 2017 will be fully extended. The real question is how much more will be added to that? And that's a question we don't have any more information now than we had 48 hours ago. There's going to be one big bill, the Omnibus Reconciliation Bill for the 2026 budget, whatever they call that bill. That's the train on which all these tax cuts are going to have to be laden. The one that's most important for business are the two corporate tax breaks, the two big corporate tax breaks. One, reducing the corporate tax rate from 21% to 15% for domestic production. How exactly is all that going to be defined, and is that going to occur? And then secondly, the reinstatement of full expensing of R&D and expenses and equipment purchases for domestic production. Both those things could have a meaningful impact on corporate earnings. There are a lot of other tax breaks which wouldn't affect corporate earnings, but would certainly amount to fiscal stimulus. If you do eliminate taxes on tips, overtime, Social Security, put in a tax break for people buying new vehicles, restore the full deductibility of state and local tax deductions, you both worsen the debt and the deficit in the long run by a lot, but you also put a lot of fiscal stimulus into the economy. And that actually brings up one other thing, which is the president has wants to establish a government department of government efficiency. He's got a quasi group right now outside the government doing this, but he wants to put them in the government to find essentially waste that can be eliminated from the federal budget. There is obviously some there, but again, as I go through in my notes in the week ahead and on my podcast, once you say you're not going to cut Medicaid or Medicare or defense or net interest, you just don't have enough money there to make a big impact on the federal budget. And one thing, I've heard people say, well, wasn't a lot of the employment growth we've seen in the last few years just government employment? Well, we've seen in the last year or two, yes, because we've seen better government employment because it was actually very slow to come back after the immediate pandemic. A lot of people went to the private sector, not the government sector. But of the job growth that we've seen in the last 4 years, only about 150,000 workers have been actually in the federal government. Most of the job gain, about 1.8 million jobs, have been added in state and local governments. So that is where all the job growth has come from. But it's not in the federal government. There are 3 million federal employees. And you can cut that number by some. And I know that one of these executive orders is a hiring freeze. But it's not going to make a meaningful impact on a deficit this year, which is $1.865 trillion. To put this in perspective, and this is the last thing I'll say, and I'll turn it over to Gabriella. But there are roughly, as I said, 3 million civilian federal employees who make an average of just over $100,000 a year. That means the total payroll bill for the federal government for civilian employees is just over $300 billion. The deficit this year, again, is going to be $1.865 trillion, according to the Congressional Budget Office. So firing every single federal civilian employee would save you less than 1/6 of the budget. So I do think that whatever happens, we're looking at rising debt and deficits going forward. That'll probably keep interest rates on a higher track. And I think that's something the bond market has been very cognizant of. The real question is, does it cause an increase in inflation? Right now, the market is pricing in 1 or 2 rate cuts from the Federal Reserve over the course of this year. I think how these policy actions are roll out, and particularly what we're seeing as being doing to the 2026 budget, will have a big impact on whether the Federal Reserve feels like it can cut even as many as two times this year. They may just stay and hold altogether if the inflation outlook looks less benign. And that's something to think about too, because if you've got a $30 trillion deficit, a 1% increase in interest rates costs you $300 billion. 1% on government debt interest rates essentially is the equivalent to the payroll of the entire civilian federal government. Something to think about. Anyway, with those thoughts on the initial moves in terms of policy from the new administration, I'll turn it over to Gabriela to talk about corporate profits and how to invest today. Gabriela?
Great. Thank you, David. Thank you so much. That was such a helpful backdrop in terms of the 2024 economy, as well as some of the initial information we're getting from policy. I think I'd first just quickly like to start with how different asset classes have been responding to the macro and policy backdrop. Starting with bonds, as David mentioned, I think a lot of that has been driven first by changing expectations around the Fed. So in the fourth quarter, we had the 2-year move up 70 basis points. We took out a couple of rate cuts from next year or this year. And a lot of that, of course, driven by a resilient economy. But it's more than that, though, because really it was the long end of the curve that moved up more. We had the 10-year move up 110 basis points from September 18th up until CPI day last Wednesday. And it wasn't really, I don't think, about inflation concerns coming from tariffs or less immigration, because inflation expectations only moved up 30 basis points. So that leaves us with the reason behind this move in the long end being much more about the real yield. So to me, that's a sign that the bond market is paying a lot more attention to what's happening with the budget and the fiscal discussions. And so the most important thing in terms of bond investing, but for asset classes broadly, including currencies and stocks, is really going to be how the 10-year reacts from here. Since CPI day, post-inauguration, we have had a move lower in the 10-year by about 20 basis points, but we don't think we're out of the woods. We do still expect some interest rate volatility, this time driven a lot more by fiscal policy rather than Fed policy. So we'll have to see how the details emerge. I think pretty consensus that the 2017 Tax Cuts and Jobs Act will be extended. That's been understood since mid-September, when the probability of a Republican sweep started increasing in probability markets. So it's much more, what new information do we get? Do we get additional tax cuts? What kind of offsets do we have on the spending side? That's much more what's going to be driving the 10-year from here. So how do we invest in bonds? We would focus a lot more on credit risk than duration at the moment. So feeling a lot better about corporate balance sheets as well as consumer balance sheets. So a lot of opportunity to pick up income and things like investment grade, high yield, asset-backed securities with good fundamentals. In terms of duration, we think short duration still makes sense. And as the 10-year adapts to changing fiscal dynamics, then maybe further down the line, there's an interesting opportunity to add duration. The next asset class I think is being tangentially very affected by this are currencies. So the dollar moved up 9% just in the fourth quarter of last year. I do think that had a lot to do with widening interest rate differentials between the US and the rest of the world. So you had a widening there of about 30 basis points, and that tends to be very related to short-term currency moves. I think perhaps the concern around trade uncertainty and potential tariffs might have also been playing a role there. But should we actually get tariff implementation, I think you would see additional dollar strength to offset whatever the percentage increase in the tariff was. Since CPI day last Wednesday, with yields coming down in the US, we have seen some dollar weakness by about 1% versus the euro, the yen, the Chinese yuan, EM currencies. Maybe also a little relief that there weren't any major tariff actions on day one. Unfortunately, I also don't think we're out of the woods in terms of currency volatility. I do think tariffs will come back on the table in the second quarter. President Trump has ordered a review of our trading relationship with Mexico, Canada, China, as well as currency manipulation by different countries. That's due by April, which to me signals that trade policy, tariffs might come back again in the second quarter as a discussion. So not just rates higher for longer, but maybe the dollar stronger for longer. Next asset class, stocks. I'd like to start actually with international stocks, which have underperformed the US since mid-September. In local currency, they've just been a bit flat. It's mostly been driven by that dollar strength or currency weakness in other parts of the world. This week, we're seeing a bit of a relief improvement in European stocks, Chinese stocks. But I think if trade uncertainty comes back, that can drive further dollar strength. It could also drive some multiple contraction for international stocks like we saw in 2018 when we had the first trade war. So for me, it doesn't mean don't own international stocks, and you could have a good opportunity actually to add to the asset class down the line. To me, it's much more focusing on more long-term stories within international markets that are a bit unrelated to some of this trading focus. Things like Japanese equities, Indian equities, and Taiwanese equities, much more related to other drivers. In terms of US stocks, we had a very strong rally from mid-September to December 6th. That was the last all-time high. The US was up 9%, large cap, mid cap, small cap, Magnificent Seven, other sectors. And then you have a little bit of a correction for about a month there from early September until Wednesday of last week. And I think partly driven by the rise in the 10-year. So the initial enthusiasm driven by all the aspects of deregulation that David mentioned, and then a little bit of a pullback driven by some of the movement that we saw in the 10-year. And I think you'll continue to see that push-pull this year between solid economic activity, more animal spirits, and good business prospects. But how do the other aspects of dollar strength and higher yields end up affecting the perspective for stocks? Lastly, I just wanted to end on private markets. Not to be overlooked that there's a lot of potential policy implications that we're already hearing about. Things like less regulation or less antitrust enforcement likely to drive more M&A, maybe even some IPOs. And that's something that could be quite beneficial to private equity and private credit. We'll see. There's always a lag with this kind of private market data. But it had been very, very muted and below average for the past few years, and that'd be something that can benefit private equity and private credit. I just wanted to end briefly on earnings, and I think that's a great place to end because there's still this policy fog that can drive some volatility across asset classes, good and bad. But at the end of the day, what's really going to be long-lasting and going to drive performance is going to be fundamentals and specifically earnings. Our team, especially our research analyst, Katie Korngibble, does an amazing earnings wrap-up for us here on a daily basis. And we'll be releasing our full takeaways, Katie and Mira Pandit, on February 7th, once we have a little bit more information. But so far, very good news. Based on our tracking, earnings are set to grow a bit over 12% in the fourth quarter. Importantly, 8 out of the 11 sectors seeing positive earnings growth, some driven by revenue growth of about 4% and some driven by margin expansion of about 9%. Just a few interesting themes to tease out. Financials leading the pack, having been, of course, the first sector to report, seeing earnings growth of nearly 50%, with a 15 percentage point upside versus expectations. Part of it is a steepening yield curve and good economic fundamental, but we already started to see some of the impact from higher business confidence start to impact M&A, investment bank fees, trading. That's a sector we have conviction in for this year, partly the macro backdrop and partly what perhaps deregulation can do to buybacks, the ability of banks to restart buybacks as we have less of a focus on increasing capital. And then number two, maybe you start to see a more meaningful pickup in corporate loans if you see more broad-based improvement in business confidence. Behind financials, we have communication services and tech, still seeing some very, very strong earnings there. And I think here the main theme is to be careful with the Mag 7 specifically. Still set to increase earnings a very strong 23%, but decelerating from the 50% in the first quarter. And expectations are everything. And within the Mag 7, a lot of differences between revenue generation, monetization of AI, and semiconductor or cloud companies versus your more search and advertising and hardware-driven companies. So I think that's going to be a feature, more dispersion within the Mag 7, and also the broader broadening out of earnings in other sectors that's really picking up. I just wanted to end on some of the underperformers here. So 3 sectors with negative earnings growth: materials, energy, industrials. And industrials is one we do have some conviction in pockets of. We'll have to see how much of a broad-based manufacturing improvement there is in terms of reshoring of production. But there's some aspects of industrials that are a lot more tied to the broader build-out of the AI infrastructure, which the administration is encouraging even more than was already happening. If you think about electrification, if you think about the building of data centers, there's some interesting things there. And lastly, on energy, just a reminder that, and we have been talking about this a lot in our election and now Policy Hub, that we have to be careful with translating one-to-one policy action, specifically deregulation, to actual market performance. Under the first Trump administration, there was a lot of deregulation in traditional energy, yet the energy sector was down 40%. So that's going to be a lot more driven by global oil prices, production levels, and the opportunities within energy of deregulation are a lot more specific, right? If there's more drilling, for example, that can be good for energy equipment providers or service providers, but just being careful not to extrapolate that to the broader energy sector. We would feel better actually with utilities, specifically power utilities. That's where a little bit less regulation on natural gas would be helpful and very in line with the AI and other electrification themes. So Brandon, a lot to parse through, a lot of policy fog, but actually at the core, still very solid fundamentals for the economy, for corporate earnings, and a lot to do across asset classes.
Gabby, certainly right. Lots to parse through. Broadly speaking, what impacts could tariffs have on inflation? And then in your mind, I guess based off of your first answer and the dynamics, how the two interplay, is there a level of tariffs that could pose a real risk of higher inflation?
Thank you. Tariffs do add to inflation in the short run. There's some argument about, well, maybe foreign producers or importers eat the whole cost, and so consumers don't see it. I don't really believe that. I do think that if you put a 10% tariff on all imported goods, I don't expect the prices of all imported goods as paid by by consumers at the store to go up by 10%. It may be less than that. And for one thing, there are huge retail markups. So if you import a shirt from China and it costs you $20 to import the shirt, but then you sell it for $40, well, if the $20 went to $22, that's it's a 5% increase in retail and a 10% increase in wholesale. So I think you get a muted effect there. It does have but it has some impact on reducing the overall quantity of goods bought. I think it also, and this is an interesting point, it is very regressive. Attention Walmart shoppers, because it is your prices that are going to go up. Richer households in America spend more on services relative to goods. Services aren't going to get hit. The richer Americans tend to spend, I believe, or they may spend more on domestic goods or domestically produced goods or things with a bigger U.S. content, whereas a lot of cheap imported, plastics and materials and so forth are bought by lower income consumers. So it's quite regressive. And the reason that's important is because that does say that there's a limit, not so much to how much inflation it causes, but there's a limit to how much the American public, the voting public, will take from this. So 10% tariff across the board, it would raise a certain amount of revenue, would add to inflation in the first year. If you think about it, we import about 15% of GDP. So a 10% tariff pushes up the price level 1.5%, maybe at the wholesale level, maybe a little less than that, maybe 1.2% if you allow for the initial companies taking it on the chin. Then you take away markups and so forth, so maybe about 6/10. So you could see how if you had a 10% across the board tariff, how the inflation rate, you could add maybe 0.5 to the CPI inflation rate, maybe 0.5 to 1% to the CPI inflation rate for 1 year. But so long as it was just a one-time 10% tariff, it doesn't do any good to the economy, because you're going to have retaliatory tariffs. And, I'm not in favor of tariffs, but I'm not going to tell you that's going to give you permanent inflation, because it tends to actually drag on the economy, slow down trade, slow down the economy. So by the time you get to year 2, you don't have any further increase in these prices. You've actually got a slower economy. So I think you do get a temporary inflation impact from this, which the Federal Reserve will pay attention to. But I think for the Federal Reserve, it's not just about the tariffs. It's about the tariffs, but then are the tariffs going to be followed by fiscal stimulus in 2026? And so I think they'll look at both of those. Depends on the magnitude of the tariffs. I do think the tariffs are inflationary. I think more importantly, I think they reduce productivity. They reduce economic activity. They're not a very good tool in the long run for achieving anything you really want to achieve in an economy. But I don't think they will cause runaway inflation so long as they're not levied at astronomical levels.
And David, if I could add, we've also been hearing a little bit from companies about this tariff issue. So far in the earnings season, and eager to hear more, certain consumer companies, specifically retail companies, have been mentioning that they're focused on tariffs and immigration as potential issues that could hit their bottom line and primarily their margins. So we have been hearing from certain companies that they're already starting to front load certain imports to try to get ahead of any potential tariffs. And it's not like retail companies have been having a very easy go, despite very strong consumption. The consumer has been very value oriented, and this just could be something additional, a bit of an additional headache. So a bit more of a mixed bag there for consumer companies.
Well, I think that's true, I think that's true, but it also is very important in terms of what we ultimately get in policy, because both on immigration and on tariffs, it's kind of a moving target. It's not like a tax law. It's not quite clear what will eventually be done. But American business, as you point out, these consumer companies, but also American small business who are trying to find workers, they can't find hardworking, skilled workers. I mean, we've got 8 million job openings. Of course, they've got lots of hardworking workers working for them, but they're having trouble finding people to fill these positions. If you had an immigration crackdown that was so dramatic that it became much more difficult for them to fill those positions, they'd push back. And of course, these small businesses are the backbone of the Republican Party. So there will be a congressional pushback on that too. So I think in both with immigration and tariffs, I think the business community is very well aware that while they may sound like popular political issues, it's very much a double-edged sword for them.
That's right. I think there's still a lot of noise on this tariff issue. The headline after inauguration was, "Oh, we're in the clear. There wasn't any major focus on tariffs." I think these initial ones, 25% Mexico, Canada by February 1st, 10% on China, they're very much thought of as negotiating tactics, very related to the immigration, drug, defense spending issue. But this broader review set to be published in April is where then we could get a little bit more signal. And I wrote a little bit about this in my LinkedIn late last year, that we have lessons from the first trade war in 2018. The overall tariff rate, it barely increased. I mean, 1.5% to 3%. It wasn't noticeable. A lot of it was noise, but there was signal. And that was specifically tariffs on China that went up from 3% to 12% and have stayed there since then. So I think the business community and markets will be very interested to hear at the end of the day if there's further action on tariffs, specifically with China. And it might take us a couple of months to hear that.
And the one, I know we need to move on, but the one last thing I point out is that you can't have just, if you want to fund any major tax program, the tariffs can't be completely puny, because we only import about, I mean, it's a lot of money, but we import about $3 trillion worth of goods in a year. You put on a 10% tariff, that's $300 billion, but you reduce the quantity of imports, you slow the economy. You've got other issues going on. So you may only raise $150 billion per year out of that. Now, $150 billion sounds a lot, but we're running a deficit of $1.865 trillion. So it is less than a 12th of the annual budget deficit would be covered by a 10% tariff. And if you want to have further tax cuts, you need a lot. So you're not going to get very far in terms of funding anything with, I mean, I don't believe in them as a revenue source. I don't think we should be doing this. But if you have a 5% tariff, it's not going to get you any meaningful money at all for funding a tax cut.
Thank you both. Gabby, you actually hit upon one of my questions on margins. So I'm gonna pivot a little bit and dive a little bit deeper into one of your comments on credit specifically. So we have some questions coming in asking how we balance the risk and opportunity of given where spreads are at today, and how we view spreads in the broader context of actual yields and the opportunity set more broadly.
Thanks, Brennan. And you've done a lot of work on this question around corporate spreads, because basically it's been mirroring the behavior in US stock markets, right? Credit, things like high yields, even investment grade, the spread itself is really based on risk appetite and of course, what's happening with corporate fundamentals. So we're back to having near all-time tight spreads, specifically in high yield, after a little bit of a wobble in December. So when you look at opportunities in corporate credit, it is really not valuation-based. It is also not based on any meaningful expectation of price appreciation, either from spread compression or from just the treasury yield actually coming down. So really what we're left with is looking to corporate credit for the income that it provides, and without, at the moment, having to worry about big downgrades and big defaults. So I think that's a broader message for fixed income. It's really about that income. And so when you look at something like investment grade, not even very long maturities, yielding 5.5%, or high yield yielding close to 7.5%, that's quite appealing. And it's higher, the income is higher than we've had half the time over the last few years. So the spread, near all-time tights, the yield significantly superior to the last decade that we lived through.
Thank you, Gabby. Related to high yield credit, the equity market, we're getting a lot of questions on equities, particularly as it relates to the Magnificent Seven and some of the initiatives we've seen come out regarding increased investment in AI infrastructure. So broadly speaking, the question is, how do we view market concentration risk right now within the Mag 7? What would a sell-off for the Mag 7 mean for the broader market if it were to materialize? Then also, what opportunities do we see moving forward with some of these increased initiatives, this increased investment?
Thanks, Vernon. And I think when we think about stocks, of course, we never know exactly when, but there will be a correction. But if we think about potential catalysts for a correction down as the year goes on, part of it is the policy fog, which we discussed. And I think unrelatedly is just the high expectations, high positioning, high concentration within a handful of companies, and a lot of them within that Magnificent Seven group. And it's not that we think it's a bubble. No, it's been driven by back-to-back years of 30% earnings growth. It's also not driven by a big expectation of earnings decline by any stretch. It's still looking like over 20% earnings growth for the group, and a lot of companies already monetizing the AI theme. But it's purely that maybe it's just not magnificent enough. That's it. And if you think about it, you've seen that during the last two earnings seasons. Some of these companies have reported incredible numbers that just didn't quite meet the mark, right? As in life, your expectations just get higher and higher, and it takes a lot more to really fulfill those high expectations. We saw that, for example, in July, we had a 15% correction in the Mag 7, and we've seen it since then, a lot more dispersion within the group. So we'll see. These companies are all going to start reporting, a lot of them, over the next 2 weeks. So we'll get more information. When it comes to the administration, so there was a big event yesterday at the White House, including 3 big tech companies, and an announcement of a venture investment of $100 billion that could be scaled up to $500 billion over the next 4 years to build AI infrastructure. So, to be determined on the details, whether these are projects that were already taking place related to the build out of data centers or if it's net new. But regardless, I think it continues that theme of a lot of CapEx around this. It reduces maybe the risk of being disappointed in that CapEx spend in 2026 and beyond. But really, to me, the primary risk is just how big these companies have gone, how big expectations have gotten, and how much concentration a lot of investors already have in this theme. And, there's a second, third, fourth, fifth derivative of this AI theme. It's already started playing out with utilities, with other kind of tech companies in private markets. So it's more than time to start branching out that investment theme.
Plenty of opportunities to get broader exposure to the market. So thank you, Gabby. David, I want to come back to you here. And we've seen that manufacturing has largely lagged behind services in recent years. Well, we're getting a lot of questions as to whether you see that changing under the new administration, given some of the policy proposals we've seen.
It's going to be tough. I mean, I think there are some positives. I mean, deregulation is positive. I think there's certain areas of manufacturing. If you ended up with cheaper energy, I suppose that helps manufacturing. But against that, you're going to think about manufacturing as global manufacturing. And the problem is that, while we will obviously try to increase tech production in the United States. We're doing that already. We're going to be fighting a high dollar and retaliation. The dollar is already extraordinarily high by historical standards. It's close to its highest level in real terms since 1985. And in part, that's, I think it's rallied even more since the president's come into office. And, Gabriella was talking about how other countries might depreciate their currency to the extent of the tariffs. And it's funny to think about it that way, but that is quite possibly what will happen. And so that already pushes up the dollar higher. But it makes it very difficult for U.S. exports to be competitive. And it makes it even more difficult for them to be competitive than those countries put retaliatory tariffs on U.S. exports. So I think manufacturing is going to have a tough time from that perspective. And in addition to that, again, if you think about it in terms of global manufacturing, the global economy is doing okay. But it's, I guess if you look at China and Northern Europe, they're not exactly booming here. And I don't think the global economy is growing fast enough to cause a cyclical revival in global manufacturing, never mind U.S. manufacturing. So I think it's a close call. I don't expect to see massive repatriation of manufacturing jobs into the United States. There are two reasons for that. One of them is that usually by the time a job leaves the United States to a manufacturing facility elsewhere, it's a pretty low-paying job. And American workers really don't want to do that job. But also we've got this tremendous AI boom, automation, the potential for robotics. So you could have decent production growth, maybe through AI and robotics, but also continued efficiencies at the factory floor, which means you just don't get a big increase in manufacturing employment. So I don't think you're going to see a massive increase in manufacturing employment over the next few years even with policies which are seen as being pro business.
That's really interesting. It's much more about not the old drivers of manufacturing for US manufacturing, but much more about the new drivers of manufacturing coming from AI. Because remember, you can build all the large language models and cool uses for AI that you want, but you need physical infrastructure as well. You need the data centers, you need the power generation, the transmission lines. So you're already seeing a little bit of a revenge of the physical world. And that ends up showing up in certain industrial companies, utility companies, infrastructure investments, private credit to finance this. So you're already starting to see this theme come true, but much more driven by new tech innovation.
Got it.
And I would say that there is a crunch on electricity consumption, and it shows that I know it's very hard for me to say this if it was sitting in New England here, where it was actually -7 degrees this morning in my house or outside. Thankfully, not in my house, but we are getting hotter summers, and that means you get this peak load need for capacity in the US, which is really pushing up electricity demand. So you've got that with data centers. You really do need more electric infrastructure. And if you don't get it fast enough, you end up with higher electricity prices, which of course are not good for manufacturing.
Thank you, Wilf. If we zoom out a bit over the past 2 days, a little bit more clarity in terms of policy, but that policy fog still largely exists in many aspects. And against this backdrop, important to not only diversify our portfolio, but take advantage of the opportunities as they present themselves. So Gabby, David, I want to thank you both for a great conversation today. And thank you all for joining.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.